Let's take a break from the whiteboard videos to have a little financial planning fun. The White House just released Joe and Jill Biden's tax returns, and I'm going to simulate what it would look like if they came into my meeting and wanted a second review of their finances. Now, of course, with this is just for fun. This should be considered educational and hopefully entertaining as well. This is not tax, legal, or investment advice. And fortunately for many of you out there, but unfortunately for Joe and Jill, I don't work with politicians. I do work with oil and gas professionals. So even if they wanted to work with me, they're not my target clientele. Lastly, I picked them because it's their current tax returns as our current president. Please let's keep politics aside. Now, with that, let's dive in. Joe, Jill, it's an absolute pleasure to meet you. I'm excited to meet with you today and give you a second look of the financial planning opportunities I see based on your tax return alone. Now, let's dive in. As you can see on the screen, we've got your tax return pulled up. First, I want to just start by pointing out a couple few observations, and then we'll dive into the top three things that I see in terms of financial planning opportunities. First, from an observation standpoint, if we look at your total income, congratulations. You made over $600,000 last year. So great year, great 2023. And then, of course, with that, if we scroll down to line 15, we see there is just over $568,000 of that is taxable income. Now, with a taxable income over $500,000 and being married and filing jointly, this means that your federal marginal income tax rate is 35%. Therefore, for every dollar you make after that, the federal government takes 35 cents of that dollar. Now, in addition to your federal marginal tax rate, being residents of Delaware, you also pay state income tax. We're going to assume that all of your taxable income on the federal level is also taxed in Delaware, and that is a 6.6% marginal tax rate. And lastly, because you make over $250,000, you also have to pay a 0.9% Medicare surcharge from the Obamacare administration. Now, when we add all of that up, your current marginal tax rate is 42.5% on the next dollar you make. So any income we can reduce from a taxable standpoint also then saves you 42.5 cents on the dollar. Now, there's one other observation I just want to quickly point out. If you see over here on the right-hand side at line 38, you actually had to pay a penalty to the IRS for your estimated tax timing. Now, this means that you had more income earlier in the year than you had estimated payments to report. The easiest way to fix this is to just increase your withholding that the federal government takes out of your normal paycheck so you don't have to worry about estimated payments as much. Now, with that, let's talk about the three opportunities that I see based on your tax return. First and foremost, there is an incredible opportunity to reduce the risk that you're taking with your money, as well as optimize your asset location. Let's optimize where each type of asset is held at. Second, we can really secure your future and reduce future taxes by performing backdoor Roth IRAs. And lastly, see that you're very charitably inclined. Let's optimize the way that you give money to still help the charities, but also ensure that you're getting the best tax break possible on that money. Let's first talk about lines 2 and 3 in your tax return, taxable interest, and then, of course, dividends. Having $39,000 in taxable interest on the surface is great. So that means that with these higher interest rates, you made almost $40,000 on the money that you have in the bank. Now, one of the things that jumped out to me when I looked into this further is that the vast majority of this came from WSFS Bank. Now, I'm not familiar with WSFS Bank, but I did do a little bit of research, and I saw that they're paying 4.25% on their high yield savings accounts. Now, with $38,000 in interest at a 4.25% interest rate, that means that you likely have over $900,000 in this bank. Now, unfortunately, that actually presents with quite a risk having that much cash in one institution. I'm not saying WSFS Bank isn't a great bank and that they're going to go under, but in the unlikely event that they did, only $500,000 of that would be insured by the federal government, the FDIC Insurance Corporation. Now, with this is also assuming, Jill, that you let Joe on that account and it is a joint account. Is that the case? Okay. All right. Now, if they went under it, and I'm not saying it's going to happen, you would then likely lose $400,000. So the easiest solution here would be just to move half of that bank account to another bank. The FDIC insurance limit is per person per institution. So you do need to have it as a separate institution from WSFS, and it can't just be a separate account within WSFS Bank. Now let's talk about the optimization side. As we talked about earlier, your marginal tax rate is 42.5%, and the government taxes interest as ordinary income rates. So you're paying 42.5% on this interest. That means that your taxable consequence of this $39,000 is over $17,000. Now, there's a couple different opportunities that we can do to ensure you're still making interest, but reduce the amount of taxes that you have to pay on that. First and foremost, we can look at what the money is invested in. Instead of having it in something like a high yield savings account, if we move it into municipal bonds, the interest on those municipal bonds is exempt from federal income tax. So although it's not the exact same type of investment, by shifting into a different type of fixed income, you do get tax exempt interest. So some of that would move over to 2A on your tax return. Additionally, if you want to keep that same level of fixed income exposure, it may make sense to increase the fixed income within your TSP. So Joe, being a federal employee, I'm assuming you have a TSP or thrift savings plan, similar to a 401k. So by increasing your fixed income exposure within the TSP, you're still able to have the same overall asset allocation, but you're optimizing the location. Now, with the money that is outside of your TSP, all this cash that you have, this is where then I'd move that into a low cost diversified equity type fund. That way you're moving some of this from taxable interest to qualified dividends where you get a much favorable tax rate. Now, next I want to talk about IRAs. So I noticed that on line 4 of your tax return that you had $865 distribution from your IRA, and 100% of this is taxable. One of the things that caught my eye on this is it shows me that you're not doing what is known as a backdoor Roth IRA. Now, of course, with a backdoor Roth IRA, it's getting money into a Roth IRA through a traditional IRA. And the reason why you do this, of course, is because with an income of over $500,000, you're well above the threshold to contribute directly to a Roth IRA. The missed opportunity for 2023 was about $15,000. And this consists of each one of you doing a normal contribution with the limit of $6,500, as well as being over 50, you can each do a catch-up contribution. So that'd be $7,500 each or $15,000. Now, of course, for 2024, the limits have increased with inflation. So going forward, you can put $16,000 total or $8,000 each into your backdoor Roth IRA. Great question. Now let's talk about the advantage. As you mentioned, you've got this great Social Security benefits. You've got some pension and annuities, and of course your federal government pension. With all of this fixed income, you don't necessarily need that money. By having this money in a backdoor IRA, it then grows tax-free. And you can do this as long as you're working. I know you mentioned that you have a current employment agreement that goes throughout the end of the year. Are you planning on extending employment after that? Okay, so you're planning on working another 4 years after this year. That's great. So you can do 5 years of contributions at $16,000 total, and therefore you can put another $80,000 into a tax-free account. And as that money grows over the next decades, if you don't use it, your heirs will inherit legal tax-free money. Do you have children or grandchildren that would really like to have a legal bucket of tax-free money? Oh, that's great. Okay, well, I think that this is an excellent opportunity for you to be able to build tax-free wealth and then pass it on tax-free to your heirs. Next, I want to talk about your charitable giving. I see that last year you donated over $20,000 to charity. Now, let's talk about some ways to continue your charitable giving and meeting your goals here while optimizing the tax implications of it. You mentioned that employment isn't guaranteed after this year. If you find out that you're not going to be working following the end of this year, you may think about accelerating your gifting on a tax standpoint in order to get a higher deduction when you have this higher income. So, for example, you could do a donor advised fund where you put $100,000 into this fund today, and that would be equivalent to about 5 years of charitable giving. Now, there's nothing magic about $100,000. You can do more or less depending on your entire financial situation. The advantage of doing that is then you can write that whole $100,000 off as a deduction on your income tax, but you still then control that money, being able to direct that to the different charities that you want. This would allow you to get $42,500 reduction in income taxes in 2024, while still being able to donate throughout the next 5 or so years. Now, lastly, I noticed that all of your gifting was in cash. In the future, it may make sense to gift appreciated assets to get a deduction not only on the gift itself, but also to not have to pay the capital gains tax associated with that appreciation. Or once you are retired and start taking distributions from your qualified accounts, doing a QCD or qualified charitable distribution from those accounts. That can help when you have required minimum distributions following your retirement. Joe, Jill, I appreciate you coming today and best of luck in the future. I hope you enjoyed watching that as much as I enjoyed making it. I also hope that you saw the power of having a qualified professional review a tax return. Now, if you work in oil and gas and would like to see what financial planning opportunities I can observe within your tax return, please reach out to me for a free consultation.